Hi, welcome back. Our previous lesson was on economic versus accounting profit. Today, we'll be moving on to average revenue, average cost, and your profit margin. In order to measure whether a business is profitable or not, we need to focus on a couple of key metrics, and these include revenue and the cost. So let's begin with our average revenue curve. Average revenue simply measures the revenue generated per unit of output sold. So it is calculated as your company's total revenue from selling a product divided by the quantity supplied. So this is represented with this formula here. If you charge everyone the same price, then essentially your average revenue curve is simply the price of each good sold. So to see this, if we simply rewrite our total revenue as the price times the quantity, which is the formula for total revenue, and then we divide it by the quantity, and we cancel these two out, then we're just left with the price. So what we're saying here is if you have a business and you charge everyone the same price, then the average revenue curve simply represents the price. So if this is the case, then in calculating your profit, you can simply replace your average revenue with the price that you are charging. Now let's move on to the average cost curve. The average cost curve is the per unit cost of production, and it is calculated as your business total cost divided by the quantity that you produce. Our total cost can be split into two, which is variable cost plus fixed cost. So if we divide both of them by the quantity, then this average cost formula can be rewritten as the variable cost divided by quantity plus fixed cost divided by quantity, where we call this your average variable cost and we call this your average fixed cost. So we can rewrite our average cost as average variable cost plus average fixed cost. So when we say variable cost and fixed cost usually include costs such as land, equipment, and any expenses that do not vary with the quantity you produce. So usually these are costs that you incur once, mostly at the beginning of the business, and then you spread the payment of this cost over some time. And then variable cost is cost that changes as your quantity changes, such as the cost of raw materials or electricity or labor, or just any other cost that varies as you produce more or less. Variable cost typically rises as output increases and decrease as output decreases. So for example, if you use more raw materials as you produce, then an increase in your output will increase the cost of raw material, and similarly for costs such as wages that you pay your labor. Now that we know how average cost is split into variable cost and fixed cost, let's represent these on a curve, and then we'll move on to profit margin using this information. So let's first look at how the average cost curve looks like. You can see from this graph that we have our fixed cost here and we have our variable cost here. So these two adding up will give us our average cost, which can also be called average total cost. When we start from a low level of production, for instance 100 or 200, your average cost typically declines, and we can see that in this area of our average cost curve. This is because you usually pay for your fixed cost just as you start your business. And in this initial stage, fixed cost constitutes large cost per unit sold. Now, as you increase your production, the fixed cost gets spread over more and more units and so becomes smaller and smaller on a per unit base. So this decline causes the average cost to fall. So eventually, variable costs start to rise with higher levels of production, and this can lead your average cost curve to rise. So this is represented by this area of our average total cost. And you can see that if you map it to the variable cost, this is also representing an increase as you increase production. So this rise in your variable cost can be caused by rising input cost or as a result of diminishing marginal product. So these two phenomena, they constitute the U-shaped average cost curve, where at initial level of production, we have a decreasing curve. And then after a certain point, we have the average cost curve increasing. Now let's use this information to calculate our profit margin. So profit margin per unit is the price minus the average cost. So remember that we said that if you're charging everybody the same price, then essentially your price is the same as the average revenue. Profit per unit sold can be calculated as the price that you charge for that unit sold and then the average cost of producing that unit. Total profit is therefore the per unit profit multiplied by the quantity that you've sold. Profit margin implies that if your price exceeds your average cost, then you are making positive economic profit. So if this is the condition of your firm, then you are making positive economic profit. So what this simply means is for every unit that you sell, you're getting more than it costs you to produce it. The flip side is that if this is the condition you're in, then you have what we call negative economic profit. So what this implies is it costs you more to produce per unit than you're getting in terms of the price per unit sold. Now we can use this information to draw our graph to see clearly what we mean by the profit margin. So remember that a firm's demand curve can also represent the price that is being charged by that firm. So in this analysis, we are going to infer the price from the firm's demand curve, and we have our average cost curve. The profit margin is therefore this shaded area between the firm's demand curve and then the average cost curve. Now, what do we mean by this? For instance, if we are at this point, Q1, at this point, if we look at the demand curve, we can say that the price that the firm is charging is P1. But at the same time, the cost of per unit production is P2. So this means that this area here is the per unit profit that the firm gets from producing Q1. So you can immediately see that any area in this shaded region where the demand curve lies above the average cost curve is a profit margin area, because we've said that anytime the price that you charge for a good is higher than the cost per unit of production, then you are making positive profit. Now we can also see that after quantity Q star in this area, then the firm is making negative economic profit. So let's look at this. So if we are producing at this quantity Q2 and we map this to our price, then we can say that the cost per unit of production is P3. But if we map our demand curve, then we can see that the price that the firm is getting for that unit is P4. So therefore, since the cost is bigger than the price per unit, the firm is therefore making negative economic profit. So what we have shown here graphically is that for any given quantity, your profit margin per unit is the gap between your firm's demand curve and its average cost curve, which is the shaded area. Now remember that the firm's demand curve is the average revenue curve because in this case, the average revenue per unit is the price. So there's a profit opportunity whenever your firm's demand curve lies above your average cost curve. And this means that the price per unit sold exceeds the cost per production. Now, in the flip case is if your cost per unit exceeds the price, then you're making negative economic profit, and the firm should consider reducing quantity produced, maybe to Q star in this example. So this is all that we have on our lesson on average revenue, average cost, and the profit margin. Our next lesson will be on free entry and exit in the long run. If you enjoyed today's lesson, consider subscribing. Thank you.